According to Rystad Energy, reparation costs for energy-linked infrastructure as a result of the war could be anywhere from $34 billion to $58 billion. But it's not just the cost, it's also the timeline. While Wall Street isn't definitive on how long it could take to restore full oil output, most agree it won't be weeks. Here's what the CEO of the Kuwait Petroleum Corporation said late last month, quote, the full production will come within 3 or 4 months. And the International Energy Agency chief telling Bloomberg yesterday that it could take up to 2 years to restore a meaningful share of energy production lost in the Iran war. So how is today's move a knee-jerk reaction? Joining us now is TD Cowen Managing Director Jason Gabelman. Jason, great to have you with us.
Thanks for having me.
What did you make of this reaction, the 11% pullback? No, I know you cover the stocks. We saw a sharp drawdown in the stocks as well. Was this premature?
Certainly seems the market is shooting first and asking questions later. It's still unclear if the Strait is more open today than it has been the past few weeks. You have Iran continuing to say you need to approve ships with the IRGC before passing through the Strait and go along the Iranian route. Which is the similar kind of route that's being taken by these ships the past few weeks. So it's unclear if today's news is going to result in additional ships transiting through the Strait of Hormuz. We'll have to see how things play out over the weekend.
I like what you did with your note, Jason, in terms of sort of gaming it out. It's like a choose your own adventure of what you think could happen in the war when it comes to opening the Strait and oil production. Permanent peace is scenario 1, tenuous ceasefire scenario 2, scenario 3 as conflict continues. In your view, what is the most likely and who are the winners?
Certainly, it's very difficult to predict what the most likely outcome is. In the near term, it seems like you could have a tenuous ceasefire. And once again, it's unclear to what extent the Strait will be incrementally open from where it's open right now. Over the medium term, all parties have an interest to reopening the Strait. It is the global economy cannot absorb the Strait being closed for an extended period of time, much longer than it's already been closed. So we do ultimately think the Strait reopens with some downside to equities in the near term, but then perhaps some upside in the medium term. Even if you do have the Strait reopen, you'll have commodities stay elevated, particularly global gas prices and diesel prices, which benefits some of the midstream players, some of the integrated oils, and the U.S. refiners as well.
Jason, I mean, it's intuitive that the forward curve, if you go out several months, it's not going to have as dramatic a move on a day like today. But you had December WTI down 4 to 5%, so still above 72 at this level. Does that feel like approximately the level that is incorporated into a lot of the stock valuations at this point? What are equity investors assuming there?
Yeah, I think we've seen, especially after today, maybe the stocks have a bit of an overreaction to the downside. And you have to remember, even prior to this conflict, we were going to move from an environment that was oversupplied to an environment that was more balanced to even undersupplied, with U.S. shale production plateauing and non-OPEC production slowing down. So the environment was always going to get better over the next year. You add to that a higher geopolitical risk premium as a result of the conflict and you know, that being sustained in the oil price even coming out of the conflict. And we do think medium-term oil price expectations should be reset higher. And that's what we've seen speaking to investors, assuming WTI around $60 prior to the conflict. Now stocks likely pricing in something closer to $70, which we think is the right number to price in.
So let's price that in for the rest of the year, Jason. What are your picks based on that forecast?
Yeah, so within the IOCs, we like Total Energies a lot. That is a French international oil company. It's had the best return on capital employed the past couple of years, and looking forward, the highest production growth and free cash flow growth, and a power business as well. So we think that one continues to gain. Amongst the refiners, we like Marathon Petroleum, ticker MPC. That one has exposure to West Coast cracks, which have been extremely strong this year due to the tightness in the Pacific Basin as a result of the Middle East conflict. And then Cheniere we like as well, given its exposure to global gas dynamics and an expectation that global gas prices stay elevated in the near future, even if Hormuz reopens, because it will take some time for those flows to resume out of the Middle East.